Hello everyone, a very good morning, and today we are going to begin with double A revision. So as we all know that the exams are proceeding now, and a lot of you might have a lot of questions regarding double A if you all are giving the attempt, or maybe you all are planning to give the attempt, so you just need to have an idea about what the paper is about, what questions are frequently asked, and all of that. So I am 100% sure that all of your doubts are going to be solved here. Okay. So in case you have any questions, you put the questions in the chat box and the questions will be answered by us. Okay. So today we are going to study about AA, that is Audit and Assurance of your ACCA. We are also going to study what is the entire topic about. Like what is the fuss about AA, that it is a theory subject, it is different from all the other subjects, the paper pattern is different from all the other subjects, and all of that we are going to study here today. So we begin with day 1 of AA revision. We are going to have 5 days of AA revision. In that we are going to do various mock papers. We are going to do, just a minute, okay? We're going to do various mock papers. We're going to study about the syllabus. We're going to study about the common and the frequently asked questions. I'm going to tell you how to study, how to go about with it, and also I'm going to tell you about what the paper consists of and what is the important topic that everybody should know. Considering this is a professional paper, obviously we do not have any choice to leave anything for option. But we can at least focus on the point which is extremely important. So that is the case. So proceeding with our AA revision day 1. I would first like to talk a little bit about myself. Okay. So my name is Sancia Gonsalves and I will be your tutor for AA. I have completed my ACCA and I have done Master of Commerce in Accountancy and Taxation. And trust me, while I was studying ACCA, these were my favorite subjects which I have experience of teaching for 5 years. I loved AA, I loved AAA, I loved APM, AFM, FM and SBR. Apart from these, I loved all the subjects, but these are my favorites. Okay. So, when I was doing it and, there was a lot of fuss regarding that particular subject and people said, it is different, the paper pattern is different, it is theory, it is boring. I would like to break that myth. It is not boring. It is the most amazing subject that you will come across because AA is beautiful. Once you understand the subject and you relate it to your real life situations, nobody can stop you from passing ACCA. If you attend our classes, I teach at Lakshya live classes, you would know how interactive and how amazing the session is. So when you relate it to your real life examples, when you relate it to your daily lifestyle, the AA subject as an auditor, if you go into the company, so if I'm the auditor, I go into the company, how will I react, this, that, you will understand how beautiful it is and how simple it is. So just by relating it to your daily routine, you will know that it's so simple. You just have to identify the risk, you just have to give the responses, you have to identify the deficiencies, you have to give the responses and etc. So it is that simple, trust me guys. And with this spirit we will proceed further. So that's all about me as a tutor. I have done my Master of Commerce in Accountancy and Taxation. Along with that, I have completed my ACCA. I have a teaching experience of 5 years and I am 100% sure that my experience is going to give you an amazing exposure of AA subject. Now talking about the institute that we all are a part of. So we are part of Lakshya, which is one of the biggest institutes we have. We have earned a great reputation as a key confidant and as a powerful institution as well as a close advisor to the aspiring candidates in CA, ACCA, CMA US, CMA India, CS, CAT, CIMA, and BIVO. So basically, these are all the courses that are offered by Lakshya. So obviously, you might have known and you might have seen the various hoardings that Lakshya puts and the amazing marketing that they do on their Instagram page on IIC Lakshya. It is a very big institute and it almost offers everything that commerce has in place. We provide a platform by availing all the courses in the syllabus, thereby making it a simple single point destination to all participants. So basically, they're providing you with the entire package. So once you take commerce, if you want to do CA, come to us. If you want to do ACCA, come to us. You want to do CMA US, come to us. If you want to do CMA India, come to us. So like once you decide that you want to take up commerce as your after 10th you want to take up commerce as your field, only one stop destination to fulfill that is Lakshya. You just come to Lakshya and you will get everything you need. So if you're taking commerce, obviously you have something big in your mind. All the courses are offered by Lakshya. You have CA, you have ACCA, you have CMA US, you have CMA India, you name it, and that is available. So we provide a platform for all those courses that are there. Lakshya is a well-known training institute providing ACCA courses in Kerala. We all are aware that it is a very big name there, okay? And along with that, they have a lot of online classes, online live classes, recorded lectures. So we are covering the entire part. So even if you're not from Kerala and you cannot attend the live classes, come here. We have online classes, we have recorded lectures and all of that. So if you don't have time even to attend online classes, you can speak to the executives at Lakshya. We also have a recorded classes package. So you can listen to the recordings at the comfort of your house, at the comfort of your timing. The entire lecture is recorded, questions are solved, everything is done. So it kind of trains you in all the situations. So if you're a student and if you want to study full time, come to the live classes. If you're a student living in Kerala, come to the live classes at their campus. If you're working somewhere but you have a dream of pursuing CA, ACCA, CMA US, CMA India, come to us. We have recorded packages. So whenever you're traveling for work and you're in the bus or you're in the train or whatever in the public transport and you just want to listen to the recording, just put your earphones and listen to the recorded lectures. So it's that simple. We constantly strive to maintain being the best amongst the ACCA coaching centers in Kerala, which is known to everybody. Okay, Lakshya is known as one of the best in providing everything that commerce offers, and that is why it is the Indian Institute of Commerce. The ACCA coaching offered by Lakshya is crafted with utmost care. So we have a pool of best faculties in place for this course at Lakshya and for every course at Lakshya, to be really precise with that. So any course that you want to select, Lakshya should be your one-stop destination, because we have faculties with utmost experience. They can answer your doubts, they can answer your queries, whatever you have in mind regarding the paper, because they've been in the field from so long. So if you have any doubts regarding how the examination paper needs to be answered, what kind of answers should be written, for what answers what markings you will get, I am sure the faculties are going to guide you well in that. Because sometimes the studying part is done by us and the studying part is like 100% done by us, but what we are worried about is what is exactly needed by the examiner. Because see, if I am a student, I know that I have studied well for my subject, whatever subject it is, but I don't know from the examiner's perspective where I stand. I don't know. For me, from my perspective, I am 100%, because everybody rates themselves 100%. So if I'm a student and I'm studying AA and I know from my end I have done everything, from myself I'm 100%. But I need to know in the examiner's perspective, in the examiner's point of view, where I stand, because examiner is going to mark me. So for that I really need guidance of the tutors. When I say guidance of the tutors, that means when you attend the live classes or when you attend such live videos, you can ask the tutor there and there on the chat box or whatever. You can ask the tutor that, what do you think, on what basis the examiner marks the paper, or what is the examiner's requirement that you write a perfect answer, because in audit we have theory. So from examiner's point of view, how the theory should be written. So all these points are addressed here in the live classes. So those who don't have time to attend the normal live classes and courses offered by Lakshya, they can attend this live classes. These are specially crafted for you guys. So quickly, this is like a quick recap of the entire syllabus at a glance, and then you get to speak your heart out, that this is my doubt, this is how things should go, what is the expectation of the examiner, and etc. This ensures that we provide the updated ACCA syllabus with the intensive training given to students. Obviously, once you join Lakshya for any course that is offered, you leave it on us. We will make sure that we train you in such a way that you are going to clear it. So we will provide you with utmost guidelines, utmost care. Of obviously, the learning part is to be done by all. That though the tutors cannot do, but whatever guidance, because it's very different. Like when you have guidance and when you don't have guidance. When you're starting it all together, you learn from experiences. But what about learning from people who have already gone through that phase and are already experienced? So we have been there, we have done the course, so we can tell you better about it. Like we can tell you, don't do this or don't do that. Just like our parents guide us. Why they guide us, and sometimes we feel, it is too restricted on us, because they have been through life, they have seen life. Similarly here also, it is not wrong to start your course on your own and go through all the hurdles. But if you're getting a free coaching, if you're getting a free live from tutors who've already been there, done that, and they can share their experiences with you, what can be better than that? So we can tell you, okay, do these kind of questions, or we can tell you, okay, focus on this part, or we can tell you, write the answer that is going to be presentable, or write the answer that is going to be attractive to the examiner. So this is what you can learn from experienced faculties that we have at Lakshya. This helps them to gain the skills, abilities, and knowledge required to appear for the exam. Because with the great faculty pool that we have at Lakshya, it is going to help you to gain the skills, it is going to help you to gain the abilities and the knowledge required to appear for the exam. Because on your own also, somewhere or the other, you will clear, but you will have a lot of hurdles because you don't have an idea of what needs to be done. Whereas once you join Lakshya, we will tell you, okay, you're doing this course, you're doing the AA subject, you need to give your availability. If you're free, if you're living there in the area where we have live classes going on, you join that. If you're living in an area where we don't have a campus, you join the online live classes that are available. If you're living in an area, obviously, where you're working and you don't have time, but still you want to pursue your education, we will give you the recorded package. So that is all the different things that we have in various languages. Now it's not that we're just targeting the Malayalam crowd and we are doing it in English, we're doing it in Hindi. So we are there everywhere. So we're doing it overall. Okay. So this helps you to gain the skills, abilities, and the knowledge that is required to appear for any exam that is offered by the institute. We have online and offline classes available in various languages like English, Hindi, and Malayalam. As informed to you, we have a lot of classes available. If you want to take a class in your Malayalam language, we have that available with our amazing faculty pool. If you feel, no, I need to take the class in English, we are there to teach you in English. We are there to do it everything. If you feel that, no, I want a combination of English and Hindi, again, we are there. We are always available. So Lakshya is there with all the languages. So basically, Lakshya is thinking about from the students' point of view. So the students will like a live online class, we have it. Students will like an offline class, we have it. Students will like a recorded lecture if they're busy, we have it. So any query, any problem that the student faces, we have a solution for it beforehand. For that, you guys need to join us and you guys need to tell what query you have. So for example, you don't have the time, okay, so then we'll design a package for you. If you don't have this, okay, then you can attend the live classes and etc. So now a lot of you might have question that what is the revision plan about? Like what is this quick recap that is happening, the quick AA recap for September 2023 exams. We all know that exams are around the corner. We all know that we need to start preparing for the exam. Obviously we have already started, but that little crisp and that little icing on the cake is remaining. So what are we going to do in this particular revision plan is something that everybody is interested to know. Like, what is this YouTube revision, what is this free YouTube revision about? We will study one of the commonly asked questions, audit risk and auditor's responses. One of the most common question asked in AA, audit risk and auditor's response. On this topic, on the topic of audit risk and auditor's response, we're going to solve 4 questions. So that will give us a practice because it is a recurring topic in the examination. Audit risks and auditor's response is always asked. So we're going to solve 4 good questions on the same. So that is going to give you a practice of how things are to be done. After the 4 questions are done, we're going to do 2 full mock papers from scratch. So the mock papers will consist of section A and section B, wherein section A will have MCQs, section B will have the big questions. So you will have an idea of how to do both. Now obviously MCQ doesn't require a method of solving. It's just your knowledge and you have to tick it. You don't have to explain why you have ticked A, B, C or D. And this is a basic knowledge, I'm just repeating it. So but we are going to have an idea of time management. So we have 3 hours, we have a 100 marker paper to give, how to manage time, how to not go overboard with the time, how to cut the time there itself, how to read the question. There's a technique of reading the question also. See, audit and assurance is a subject which is different from other subjects, that everybody needs to agree. The paper pattern is also different from another subjects. That makes the subject special. So how do we deal with this subject which is special? We need to use our tactics to answer the paper. The question is there, and I would say the bigger the question, the better it is. Take it like that. It is the bigger the question, the better it is, because they're giving you more data, they're giving you more information. I honestly don't like small questions because I feel they are not telling us enough about the company. Like, come on, tell me something about the company. So the big fat question, don't get scared when you see it. You take it like this. Great, I have so much data, now though I will rock it. So bigger the question, better it is. Okay, so we have techniques of reading the question also, because obviously the question that is going to be asked, you're going to see it for the first time. So how to remember it, how to read it, how to understand from it, because risks and responses are going to be taken from the question and written about, right? So how to do all of that, and that should be studied. So that is all that we're going to do in these 5 days of this quick recap of your ACCA. Next we're going to talk about is the paper pattern of AA. How the paper is designed to be, how to solve it, how to manage time, and all that we're going to study now. So what is the paper pattern of AA? Considering AA is a special subject, AA's paper pattern is also special. It is very different from all the other papers that are there. All the other papers are distributed in a certain way. AA is different. Okay. So what about AA? The paper duration for AA is 3 hours and 15 minutes. Okay, so that is the total duration that you get to answer the paper. Everybody knows that it is a CBE paper. So this paper needs to be solved on the computer. For that, you need a typing practice. So now you will ask me how we will get the typing practice. By solving the questions on the PC. So on the laptop. So whenever you're attending classes, whenever a question is given to you for homework, don't solve it using a book and a pen. That is absolutely wrong. Because if you're preparing yourself for AA or any other subject of ACCA, you know that now everything is CBE. So you practice it on the system, you will have an idea of it. And with so much social media hype that we have around, we have Instagram, we have Facebook, we have Messenger, we have WhatsApp, our typing speed is definitely great. So that I don't have tension about for any of my students. I know that typing is going to be great because we we are doing it daily. We are using WhatsApp daily, we're using Instagram daily. So that typing has got nothing to do with anything whatsoever. Typing is great, and that is what is required in AA. So what's the tension about? Your typing is good, using Word is easy. What else is required? Nothing else. So that's all is required here, but you just need to practice it on the laptop, because typing normally we do it on the phone, right? So the keypad and all of that is a little bit different, but the positioning is obviously the same. But just practice the questions on the laptop. So now the exam is there in September. You guys are giving the exam in September. Make sure that you practice it on your laptop. Pick a question each day. Pick a question from the examination kit each day and practice it on the laptop. Then check it yourself. Self-mark it. After all the questions from whatever kit you're referring are over, go to the My ACCA website. Go to the ACCA study hub. Pick questions from there. Solve the questions on the system and self-mark it. So that will give you a practice. Now ACCA study hub also has a lot of MCQs for you. And you can answer the MCQs there and there, submit the answer, and you also get it corrected there. So what can be better than this? You do not have to wait for anybody to check your MCQs, to review them for you, and then you will work on what the right answer is. And MCQs, you solve as many as possible. That is going to be a great practice for you. So first of all, whatever is available in whatever book you're referring to, any study text that you're referring to, do it first. Then go to the exam kit, complete the MCQs, and then go to the ACCA study hub. Select your subject, select the practice thing, select your MCQs, mark it and get it corrected there and there. So you know that where you stand, how much more practice you require for MCQ, because every MCQ is different. So the more you practice these MCQs, the more it will be better for you. That is how you prepare for an exam. See, now it is time to solve as many questions as possible, or as many mocks as possible. That is why in this particular revision course that Lakshya has kept for us, we're going to solve 2 mocks, because question practice is really important. Once you get a hang of what needs to be done in the examination, you just have to go on the examination day, sit and give your exam, because now you already have an idea of how to answer the mock, how to read the question, how to manage the time, and etc. So that's all is required here. So the paper duration is of 3 hours 15 minutes. It is a special paper, it's a special subject. It's divided into 2 sections, section A and section B, wherein section A is for 30 marks and section B is for 70 marks. So this is the division. Section A has 30 marks and section B has 70 marks, which makes it a 100 marker. Okay, now what is included in section A and what is included in section B? Let's have a look at it. Section A has 3 objective type questions. But what is the division of these 3 objective type questions? Section A has 3 objective types questions, case 1, case 2 and case 3. In each case is going to be of 10 marks. So case 1 is of 10 marks, case 2 is of 10 marks and case 3 is of 10 marks. In case 1, you have 5 questions of 2 marks each. That is the MCQ. So per MCQ is having 2 marks. So every right tick of the MCQ is going to give you 2 marks. Imagine, that's such a great news. So 30 marks you're getting just by MCQs. So every right tick is going to give you 2 marks. Similarly, in the case 2 also, there will be 5 questions of 2 marks each. Again makes it 10 mark. Similarly, in case 3 also, we're going to have 5 questions of 2 marks each. Again makes it 10 marks. 10, 10, 10 makes it 30. Section A, super simple, objective type questions. Be thorough with your theory, be thorough with everything that is there in the syllabus, and you will get these 30 marks. These 30 marks are in your pocket. Okay, simple. Nothing to worry about, just theoretical MCQ questions, case study questions, 5 questions of 2 marks each in every case. So total 15 questions of 2 marks each, that makes it 30 marks. That is all the fuss that is there about section A of your AA syllabus. And the time frame is what? The time frame is 3 hours 15 minutes. Then comes the bigger chunk, section B. So what about section B? Section B is having 3 constructed response questions. This is a case study basis. But how these 3 questions are divided in this 70 marks? 3 constructive response questions, case study based, of which these 3 questions will be, one question will be of 30 marks and the remaining 2 will be of 20 marks each. That will total make it a 70 mark chunk. Now one question of 30 marks and 2 questions of 20 marks each. Okay. In the 30 markers and in the 220 markers, somewhere or the other you will be asked audit risks and auditors' responses. You will be asked elements of assurance engagement. You will be asked control deficiencies, recommendations, test of controls. You will be asked substantive procedures. You will be asked financial statement assertions, anything from the syllabus. But risks and responses, control deficiencies, test of controls and recommendations are the common questions that are asked. And if you've solved the kit over time, the examination kit over time, you might have noticed that these are the commonly asked questions which you need to know. So that is all you need to know about what will be asked in AA, and that question is a guarantee. Okay, so you have risks and responses, you have deficiencies, control recommendations and testing of controls, you have assurance engagement, the elements of assurance engagement, we have substantive procedures for various items. We have substantive procedures for cash and bank, we have substantive procedures for receivables, we have substantive procedures for payables, for so many things. So you know what I tell my students is, you just by heart a few substantive procedures for a few procedures and keep, so that then anything else is asked, you can make your own answer in the exam and write, because we cannot predict what is going to be asked in the exam. So we'd rather prepare for a few answers. Like I'd prepare for substantive procedures for receivables, I'd prepare for substantive procedures for payables, I'd prepare for cash and bank, I'd prepare for bank overdraft, I'd prepare for what else I can prepare for? I can prepare for cash and cash equivalents, I can prepare for like all these basic items you prepare and keep. I'll prepare for plant and machinery, then like that. So then if anything else apart from this is asked, you can make your answer somewhat like, taking points from here and there. But for basics, I think you need to prepare. So if you have asked about bank overdraft, you just write it down. If you're asked about plant and machinery, you just straight away write it down. And for every substantive procedure, prepare like 6 points, because it's roughly sometimes asked for 5 to 6 marks and all of that. So that needs to be done. See, when you solve a lot of past papers, you kind of get an idea of what the questions can be. Okay, so for that reason, we're going to solve 2 mock papers at the end of this entire recap, so that we will have an idea of how to do the questions and how to thoroughly go about with it. So this is the entire paper pattern that we have. I'll give you 1 minute to just go through the paper pattern and ask me if you have any doubts. Just go through the paper pattern and see if you have any doubts in answering or anything like that. Then you can just ask me in the chat box, so we can solve it there and then. So this is the entire the hype that was created around AA, that it is different, it is this, it is that. Nothing is different, it's just this. It is special, not different. Okay, so this was the fuss. I'm giving you 2 minutes to just go through it and see if you have any doubts that why it's like that, or we didn't know that this was the distribution or whatever. So just go through that. and in 2 minutes we are going to proceed. So all your comments will be answered. I will just check if there are any questions from our fellow students so that we can answer the queries together. So all your comments will be answered. Okay, so we don't have any doubts so far. So I think we can begin. We can proceed. And all of your doubts will be answered. You just have to put it in the chat box. I will see it and I will answer it, okay? Maybe sometimes I'll be in a flow, so at that point of time I'll not be able to answer it, but definitely after that particular point is over, I will pick my phone, I will answer the question. So don't worry about that at all, okay? All the doubts are going to be answered. Now proceeding forward with our very special subject, AA, ACCA exam support. How to study, from where to study, what to do, what not to do. Very important. See, studying part everybody can do, but what is smart studying? How can we stand out? Like, how can we at Lakshya stand out from all the other students? Resources, study, everybody can do. Everybody has access to a lot of books that are available online. You can always purchase the books and all of that. But how to smart study? It's not just about picking a particular book and studying from that book and appearing for the exam. As I told you, we need to know from the examiner's point of view, like what the examiner wants, because here the entire idea is to impress the examiner. We have to write an answer, not what is best for us, not what is best in my eyes, but what can be best in the examiner's eyes. So how will I know what is the best in examiner's eyes? By going to my ACCA and reading the exam support articles by the examiner. Examiner is the one that marks your paper, and reading the technical articles. So when I read the technical articles and when I read the exam support articles, I kind of get an idea of the mindset of the examiner, that okay, the examiner expects the language to be such, or the examiner expects us to answer it in such a way. So that is required, because we are not writing it because we want to write a particular answer, or we are not writing it because we want to tell them that what we know. We might know a lot of things, but we have to write what we think is best from the examiner's point of view. So for that, the best support that can be gained is the exam support articles. technical articles. CBE practice platform will be shown live in class about how to use the CBE practice platform. And ACCA study hub. Now in the previous slide also I spoke about the ACCA study hub, right? I spoke about how to use the ACCA study hub. We are going to do it. We're going to do it in the coming classes. I will show you how to log into your My ACCA account, how to use the ACCA study hub for various things that I explained. I said you can use it for MCQs and I really loved it. I would have loved it, if it was introduced a few years back. So, you can mark the MCQs there itself. What can be better than that? Then we have the CBE platform, which looks exactly like your examination platform, wherein you get an idea of how to answer the paper. You can assign mocks to yourself, and those are timed mocks. So that will give you an idea of how to work under pressure. So you have a timer going on, and you have to answer the question. So that will give you an idea of the pressure. When we are solving mocks here at home or in your home, we don't have a timer, or maybe we don't care about the timer. We just care about finishing the paper and submitting to the tutor. But when you solve a mock on the CBE platform, there's a timer. So your mind gets trained how to answer a paper in that particular examination pressure, and that is what is required. So imagine a timer running, you have to answer the question. Timer is running, you have to answer the question. So you cannot afford to waste time, you cannot afford to look here and there. After solving a couple of mocks like that, examination will be same like that. So then your mind gets trained that I have to work under pressure, I have to work under the timed mock. So that is what is required to answer the ACCA paper. You have to read a lot of technical articles regarding the subject that you're taking, because technical articles and the exam support articles will give you an idea of what the examiner requires. The examiner is not really bothered about your grammatical mistakes and the spelling errors that you make. Examiner has nothing to do with that. But the examiner has a problem with using very simple approach to the language. At least you're studying a professional course, so according to that your language need to be a little poised. When I say language needs to be poised, doesn't mean your spellings should be correct or you should be grammatically correct. That has nothing to do with ACCA. Spelling mistakes here and there are okay, but your answer should be of utmost quality, because they're judging you on your approach, they're judging you on how you're using your knowledge to answer a question. Now, audit risks and responses, they change according to the question. One question might have a particular audit risks and responses, other questions might have different audit risks and responses. What you have to do? Apply your knowledge. ACCA focuses on what? Application of knowledge. Knowledge is there with you. You know how to identify risk, you know how to give the responses. But how will you apply that to any question that is given to you is what ACCA wants, their members to know. So, this application of knowledge. So, tomorrow when you go into the real world, when you have a client, you should be able to apply that knowledge. That is why every question that comes is different, because they teach you application of knowledge. So, in the real world also, it is going to be useful. So, when you go and when you have a client, the client tells you his story, then you apply the risks and responses. Same thing is happening in the questions. In every question, there's a different client. In every question, there's a different story. The person comes, then he gives your story. Then you as an auditor has to go to the company to audit the company, identify the risks, identify the responses. All that happens. Okay. So that will be known from the exam support articles, the technical articles, the CBA platform, which will be shown live in the class in the coming days, and the ACCA study hub, which is newly introduced, and we will show how to use the ACCA study hub. So that is something that will be covered in the class. So let's begin. So I will just look at the comments. Let anybody who has a doubt think about the doubts and ask about the same. In 2 minutes, we're going to begin with audit risk. One of the most common topic of audit is audit risk, identification of audit risk, what are the different types of audit risks that a business faces, and etc. So in the next 2 minutes, we're going to begin with audit risk. Okay. The most common and frequently asked topic in the AA exam is audit risk. So we are going to study audit risk in detail, the different types of risks that are there, and then solving questions on this audit risks. Okay. What is the main aim of conducting an audit? So why does a company conduct an audit? A simple question. We have a big subject on audit and assurance, but what is the main reason for companies to conduct audit? If you are an investor, okay, and you want to invest in a company, you have two options: company A and company B. Company A is an audited company. Their financial statements are audited by the auditor, and company B is not an audited company. In which company will you invest? Whatever money it is, say you're investing 1 lakh rupees. You will obviously want to invest in a company which is audited. What do I mean by a company that is audited? That means it is checked by somebody. Who's that somebody? It is checked by the auditor. So I'd rather invest my 1 lakh in a company whose financial statements are checked by somebody than in a company whose financial statements are not checked by anybody at all. So I would want my funds to be secure. For that, if somebody has checked a company, I will trust that person. And that person is the auditor who is appointed by the shareholders. So that auditor is an independent auditor. So if there is any problem in the company, he is going to come out in public and say that, this company that you are thinking of investing in is not a good company, or it's not a proper company, right? So it's better to invest in a company which is audited than invest in a company which is not audited, because the company which is not audited, you cannot really say about the different risks that might be in the company, because nobody has checked the financial statements. Whereas here in company A, the financial statements are audited. That means they are checked by the auditor. So I'd rather trust a company that is audited. This is the importance of auditing. So as an investor, you will always invest in an audited company because it is checked by an independent auditor. Okay. So one of the main requirements of the auditor, when the auditor goes into the company to audit a company, what is the main requirement of the auditor? Auditor needs to obtain sufficient appropriate evidence to reduce audit risk to an acceptably low level. Means what? The auditor goes into the company to audit the company. There might be many flaws in the company. Auditor wants to obtain sufficient and appropriate audit evidence to reduce this audit risk, either reduce it completely or reduce it to an acceptably low level. So the auditor basically wants to make sure that the audit risk in a company is eliminated or reduced to an acceptable level. But what is this audit risk that the auditor wants to reduce? What is that audit risk that the auditor doesn't want in the company anymore? Audit risk is a risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated. So audit risk means if the financial statements are misstated, the auditor says otherwise. That is the audit risk. So we need to make sure that the audit risks is reduced to an acceptably low level. And the only reason the companies conduct an audit is because they want their companies to be clean. They want to gain that confidence in the investors. Investors will have multiple options, obviously. When as an investor, you will not just look at one company. Even when in our daily lives also, when you want to buy a particular item, say for example, I want to buy a new phone, I will not just focus on one phone. I will have at least 4 to 5 phones in my mind. Doing my own research and development, I will decide which phone to go ahead with. I will decide that okay, this has this specification at this price, this phone has that specification at that price. So depending on that, I will go ahead with the best option and the best price. Similarly here also, investor will want to go ahead with the best company that offers best things and everything best, because ultimately somebody is investing their money in a company. They're putting all their money in the company, how much ever it may be, but that's the hard-earned money. So they would want audited financial statements, they would want a good auditor, they would want to reduce the audit risk to either eliminate it or reduce it to an acceptably low level, and all of that. So that is the main motive, you can say, of audit. Why audit is conducted? For this. So what is an example of audit risk that can happen in the company? They give an unmodified audit opinion when the financial statements are materially misstated. So if the financial statements are materially misstated, actually the opinion should be a modified opinion. But the auditor gives an unmodified opinion. That means the auditor gives a different opinion. This is an audit risk. Auditor is not acting truthful. This is an audit risk. If this were to happen, the auditor could be sued by the intended users. Disciplinary action could be taken by the relevant professional body, and the firm could damage its reputation. See, in a normal setting, there's a company. There are 3 parties: the management, the shareholders, and the auditors. So the company is conducting the operations. Shareholders are the real owners of the company. The directors are the agents of the shareholders, right? But the shareholders need to know that behind their backs everything is going properly. So the shareholders appoint the auditor on their behalf to go into the company and to check the matters in the company, right? Auditor is the person who is appointed by the shareholders. Auditor is an independent person. Why is he an independent person? Because if the auditor was dependent of the company, he would take the company's side. He would not say that my company is false or my company is doing this. So he needs to be independent. That is the whole idea about it. If the auditor is a part of the company, he will never say that the company has deficiencies. So shareholders appoint such a person who is independent of the company. So he enters a company as an independent person. He looks at all the operations of the company, he goes through everything, and then he gives his report. When the auditor gives his report to the shareholders, he is expected to speak the truth because he is an independent person. But in certain situations, he might lie. What are the situations? Wherein he's paid a bribe by the management, or wherein the management tells him and intimidates him that you just see, if you say the truth, we will make sure that you never get a job in the industry or whatever. So in these situations, the auditor can lie, and if the auditor is caught lying, the auditor could be sued by the shareholders because he is appointed by the shareholders, right? So similarly, he could be sued by the shareholders. Disciplinary action could be taken by the relevant professional body, and the firm could damage its reputation. The auditor belongs to an audit firm, and if the auditor gives a fake report and if he's caught, that can damage the reputation of the auditor's firm. That is why it is a huge responsibility on the shoulders of the auditor. What is the huge responsibility? To be independent and to keep up with the name. See, auditor is appointed by the shareholders. Shareholders are trusting and putting a lot of faith in the auditor because the auditor is an independent person who is going to give the shareholders an idea of what is happening in the company behind their backs. And if that independent person is only lying, then who will the shareholders trust? So obviously the shareholders are going to sue the auditor if the auditor is not truthful. And auditor has to work in this added responsibility and this added pressure, because auditor needs to understand that he is appointed by the shareholders. He is an independent person. He needs to go into the company and work for the shareholders. He is not a part of the management. He is independent of the management. Whatever he does needs to be from the auditor's perspective, from the shareholders perspective, because he is an independent person who goes there and independently tries to find out everything from the company. So if the auditor doesn't act in good faith of the shareholders, and if the auditor lies, then he can be sued. Disciplinary action could be taken by the relevant professional body, and the firm could damage its reputation. To avoid these potentially damaging consequences, the auditor will plan and perform the audit in such a way that audit risk is reduced to an acceptably low level. And if the auditor wants to save himself from all of this, if the auditor wants to save himself from the disciplinary action or damage to its reputation, then the auditor has to act in good faith. The auditor has to be honest. If the auditor is going into the company on the behalf of the shareholders, and if something wrong is happening in the company, he needs to come out and say that, okay, this is wrong in the company. He need not be scared of anybody. If something is literally wrong in the company, you come out and you tell the shareholders, because ultimately shareholders have invested their money in the company. So they need to know if their money is channelized through right resources. They need to know, see, if I have invested money in a company, I would have full right to know where my money is going, because I don't want my money to go into any unauthorized means. I don't want my money to go into any gambling, or I don't want my money to go into any activities which are banned by the government. So I need full right to know where my money is going, where my funds are channelized. For that purpose, I am appointing the auditor to go on my behalf and find out. I expect that the auditor tells me the truth. Okay, and if the auditor wants to avoid any consequences of lying, then he needs to say the truth. And he needs to plan and perform the audit in such a way the audit risk is reduced to an acceptably low level. So either there is no risk at all, or the risk is so small that it is already reduced to an acceptably low level. That is what the auditor needs to do. So this is so much added responsibility and so much added pressure on the shoulders of the auditor. Okay. What is a misstatement in audit? Misstatement means a mistake. What is a misstatement in the audit? a difference between the reported amount, classification, presentation or disclosure of a financial statement item and the amount, classification, presentation or disclosure that is required for an item to be in accordance with the applicable financial reporting framework. So the difference between the amount that is given in the financial statements versus with the amount that should have been given according to the IFRS standard. Example, according to IFRS standard, the amount needs to be 1000, but the amount that is actually there in the books of accounts is 500. So the difference between the two is 500. So that is the misstatement. So what is the misstatement? The difference between the amount that is given versus the amount that should have been given. Okay, so the difference between the two is the misstatement. Now what about the misstatement? Misstatement can arise from error or fraud. So for example, I had to actually write 1000, but instead of 1000, I by mistakenly wrote 100. By mistakenly, I added 10 extra. So this is an error that happened by mistakenly. Okay, it was unintentional. I was maybe in a hurry, or I was maybe in immense pressure, or I was not in the right mind frame. So I added 10 less, or maybe I added 10 more. That is an error. It is unintentional. Purposely I added 10 less, or purposely I added 10 more. That is fraud. Say for example, I need to get payment from somewhere, and the payment is 1000 rupees. Okay, and I am only filling my employee form. So instead of 1000, I write 10 extra to get that much payment. Now what is this? This is an intentional mistake. So intentional mistake is fraud, unintentional mistake is error. Okay, so this is the difference between fraud and error. And misstatement can happen. Misstatement means what? You're writing the wrong amount. Misstatement is the difference between the amount that you have written versus the amount that you should have written in the books of accounts. So this misstatement can either arise from error or fraud, wherein error is unintentional. It happened by mistakenly. You were not aware that you wrote 10 extra, or you wrote 10 less, because maybe you were in a hurry, or maybe you were very busy or whatever. And fraud is what? Purposely you wrote 10 extra so that you could extort extra money from that. So that is the difference between fraud and error. And then you have to evaluate the misstatements which are identified during the audit. Now, evaluation of different misstatements which are identified during the audit. Okay, uncorrected misstatements means there is a misstatement in the books of accounts and it remains uncorrected. For example, instead of writing 1000, I wrote 10,000, and this mistake is not corrected, so it remains uncorrected. So how will you evaluate that uncorrected misstatement? What will you do about that uncorrected misstatement? Evaluate effect of uncorrected misstatement on the financial statement. Evaluate key, because of writing 10,000 instead of 1000, how is it going to affect my books of accounts? How is it going to affect my financial statements? So I have to list down things that, okay, this is how it is going to affect my balance sheet, or this is how it is going to affect my FS. Report it to those charged with governance, that is the management. Report it to them that this is an uncorrected misstatement which you have not corrected. Because when the auditor identifies misstatements and he goes to the management, it's the duty of the management to correct those misstatements. But if the misstatements remains uncorrected, then the auditor needs to inform those charged with governance that this is the misstatement, and the effects of these misstatements will be 1, 2, 3, 4, whatever the effects will be. If the management agrees that okay, we will correct it, the matter gets over there and there. Okay, if the management says, oh, this is a misstatement and we are going to correct it. So instead of 1000, we wrote 10,000. We are going to correct it and we are going to make it 1000. The topic gets over there. But if the management says that we are not going to correct it because it doesn't matter, it's not a very big mistake and all of that, if the management tells you like that, because the management is capable of telling you anything. And when I say telling you, I mean telling the auditor, because we are the auditors here. In audit, whenever I say telling you, or when you go in the company, that means you means not your own personal individual going there. That means you as an auditor. Because in audit, we all are auditors. We are from the auditor's side. We are the auditors. So when the management tells you that, you know what, it's not required to correct it because it's not a very big misstatement, it's just 1 0 extra, it doesn't matter. And if the management tells you that, you need to request written representation from the management saying that you give me in writing that this is not a big mistake, it is not material. So that tomorrow, if the shareholders catch me and if the shareholders tell me that why you didn't tell us about this misstatement, you can show them, see, I had told the management to correct. The management said that it's not a big mistake. So I had done my job from my side. This is for your safety, for the auditor's safety. Because as I told you, the auditors are appointed by the shareholders. Auditors are answerable to the shareholders because they are appointed by the shareholders. So if you want to be in the good books of shareholders, you have to be safe from all the sides. So if there is a misstatement which is uncorrected by the management, you inform the management that this statement needs to be corrected. If the management corrects it, the topic gets over there only. But if the management says that we are not going to correct it because it is not material, it is not big mistake, it is just a normal mistake, tell them, give it to me in writing. Simple. So tomorrow if any shareholder questions you in the AGM, you can show them that the management has given me in writing. So, right? So that is about uncorrected misstatement. That is one category of misstatement. The second category of misstatement is the factual misstatement. Factual misstatement means mistake as a matter of fact. Means the misstatement is so deep that by its very fact itself it is a misstatement and it needs to be corrected. For example, we have studied since our school days. The sun rises in the east and sets in the west. This is a fact. And not me, you, nobody can change this fact. The sun rises in the east and sets in the west. It's a fact. Today, in today's class, if I tell you the sun rises in the west and sets in the east, is it correct? By very fact itself, it is a misstatement. Like, what am I saying? It is factually wrong. It is factually impossible. Or if I tell you the earth doesn't rotate at all, it's factually wrong because scientists and people have proven this fact that the sun rises in the east and sets in the west. So if I'm saying anything other than that, that means my misstatement is so much that it is factually wrong. So there is no doubt about this misstatement and it needs to be corrected. So that is a factual misstatement about which there is no doubt. It is wrong, it is wrong. By the very fact itself, it is wrong. So that is factual misstatement. Next, judgmental misstatements. Now you know that auditors are of different categories. Okay, all my students tomorrow will go and become auditors. Every person's thinking capacity, ability to apply the knowledge is different. So with different people come different judgments. For example, I am one person. If I go into the company, my way of working is going to be different. My way of applying the knowledge that I have studied is going to be different. If there is some other person that is coming after me, his or her way of applying things is going to be different. His or her way of teaching things is going to be different. So different people, different styles, so that are different judgments. Every management will have a different judgment. So the next misstatement is about judgmental misstatement, arising on management's judgment on accounting policy and accounting estimates. Every person has a different judgment. So there can be misstatements on various people. You might like a particular person's style of working. You might like the person's flow of working. The other person might work a little different way. You might not love it. So that is the misstatement that occurs because of judgment. One person judged that there was no misstatement, but the other person who came said, no, there is a judgment. There's a mistake, and according to my judgment, something is wrong there. So these misstatements depend on person to person. So that is why, since it depends on person to person, they are known as judgmental misstatements. Okay, because it depends on the various judgments that are available. Every person that comes new into the company brings a fresh air of energy into the company, which is something different, because they have not studied the company in advance. They have not seen other people work in the company. So whatever they come and do in the company is very fresh and different from whatever is happening in the company. Okay, so that is the new judgment that they bring. And then sometimes you also observe these newcomers and feel that, okay, this is a good style of working, next time I should inculcate that. So when you do a lot of questions in your audit, your exam kit, you have auditors risks and responses, and after you're done writing the answer yourself, you go and self mark your answer, right? So you look at the solution, you look at the answer, you look at the solution, you look at your answer, and then you feel that, see, in the solution they've written so beautifully, that is, they have used their judgment. In your solution you have used your judgment, and then you feel, this particular point is very good. Next time I'm solving a similar question like this and a point comes, I'm going to add this point. So you like kind of star mark and write it. So you like that person's judgment. You were like, when I read the question, I didn't think about this particular audit risk coming, but in the solution that person has thought about that audit risk, so that is his judgment of that misstatement. My judgment was different, or maybe I didn't even notice that there is going to be a risk for this matter, but then you like somebody else's judgment, so you kind of grasp it and you understand that next time I'm going to face a question like that, I'm going to take that. You'll also kind of learn from your experiences. Obviously people who are working in the field from a long time have more experience than what, and that experience is going to count in your judgments. Like, say, if I'm working for the last 10 years in the audit industry, I know that whenever I have a company of this category, there is bound to be an audit. Whenever there's a new client, there is going to be an audit risk that I don't know the client, I don't know about the principles, I don't know about the various accounting estimates, the accounting policies that the client has. So there is a risk of misstatement because I don't know the client. So what can I do? What can my response be for the same? I need to exercise professional skepticism. I need to first study about my client, because I have a very big company. For example, I have new clients coming to me. So whenever there's a new client that is coming to me, the first audit risk that comes to my mind is, I don't know about the client, I don't know about his policies, I don't know about his style of working. So that is an audit risk for me. How will I combat that audit risk? Like, what is my response going to be? Study about the client, get information about the client, and maintain professional skepticism. Be alert to all the risks and conditions of the client, since it's a new client. We don't know anything about that. So we from our sides need to be prepared that, okay, this is a new client and I need to be extra cautious. First I need to study how the client operates, in what industry he operates, this, that, and then I can start my work. So with experience come judgment. Okay, so the next type of misstatement is judgmental. It depends from person to person. You might find there's a misstatement, it is your judgment. Okay. And the last one is the projected misstatement. What is a projected misstatement? The auditor's best estimate of the total misstatement in a population through the projection of misstatement identified in a sample. From all the population that is available, the auditor's best estimate of the misstatement is projected misstatement. For example, I projected a figure on the screen. So that was my best estimate that I have projected. Similarly, the auditor, of all the misstatements that he has identified, feel that this is a very important misstatement and that needs to be projected, that needs to be highlighted. So projected misstatement is the auditor's best estimate of the total misstatement in the population. Best estimate. This is the maximum misstatement that can happen, and the auditor wants to highlight it or the auditor wants to project it. So these are the different types of misstatement identified during audit and how to evaluate the same. So I will give you 2 minutes to go through this. Till then I will check the comments. Okay. Please go through it. Any doubts in these four, please ask me. In 2 minutes, we're going to begin with the next part. Okay, so now next we have is the different types of audit risks. The three basic types of audit risks are inherent risk, control risk, and detection risk. So what is inherent risk? This will be considered at the planning meeting as it depends on the auditor's knowledge of the business. It's the risk of material misstatement in financial statements due to the characteristics and nature of the business. So it is like an inbuilt risk which is already there in your business that you cannot avoid. I'll give you a very simple example of inherent risk. Sometimes diabetes or certain health conditions run in the family. So you inherently get it without you doing anything. For example, diabetes. A certain family has diabetes. So even if they eat sweet, don't eat sweet, doesn't matter, it's there already inherently in them, they cannot change it. Similarly, certain businesses are inherently risky. For example, if you see the sugarcane industry, sugarcane field and sugarcane factory cannot be located at a very long distance because the sugarcane, as soon as it is cut, starts to lose its sweetness. So this is an inherent risk of the sugarcane industry. So if you want to enter into the sugarcane industry, you have to make sure that your factory and your field is very close by, so that you can make the most of the sugarcane and you can make a profit. If it's very far, as soon as you cut the sugarcane, it's going to start losing its sweetness. So that is an inherent risk in the sugarcane industry. If you see the fashion industry is very fast growing, it's very fast forward, and it's very fast moving. So if you want to enter into a fashion industry, you need to know things that, for example, a particular movie comes, so a particular fashion it brings, and the quicker the fashion comes, the quicker it goes also. It becomes outdated. People don't like buying a lot of outdated stuff also, because then it is like, there's something else coming in fashion and then you're still at that outdated fashion. So fashion changes quickly. So if you're into that industry is inherently risky because the fashion keeps on changing. So if you have excess stock, you need to have the right stock. Like if the movie comes out, you buy clothes like that, the stock is over. Like the Barbie movie came recently, everybody was wearing pink, there was so much fuss around, and I went to see the movie, and everybody was dressed in pink. That's just a phase, right? After a few months, nobody would want to do that. So if you are into that fashion industry, whenever the movie came, you should be quick enough to react also to the market. That okay, all the pink products at display, after a few months they're gone. And the stock also needs to be ordered in a proper quantity, because if you order stock more than required, then it'll be outdated and it'll just lie there. Nobody will want to buy it after a few months. Till that fuss is there, till that Barbie fuss is there, obviously people are going to buy. But beyond that, people will not. So the industry in which you're entering, you need to be well versed with that, because certain industries are inherently risky. Like the fashion industry is risky in that perspective, the sugarcane industry is risky in that perspective. Fashion keeps on changing daily. It is possible that a lot of items get outdated, so you need to order the right quantities. You need to make sure that you are selling the right quantities to the right amount of target audience and all of that. So that is inherent risk. You cannot avoid this inherent risk because it's inherently there into the business. You cannot do anything about it. You cannot avoid it. It's there, so it's there. Right, sugarcane starts losing its sweetness, so it starts losing. You cannot do anything about it. Fashion industry keeps on changing. You cannot hold it and keep it. Right, so that is the inherent risk that these kind of industries face, and you cannot do anything about it. Now, if there is diabetes in your family, there is diabetes. Yeah, you cannot control it. It's a different type of diabetes, which is ever since you're born. So that inherent risk, you cannot really do anything about it. Next type of risk, control risk. What is a control risk? Simple. We are trying our best to simplify things. We do not want to complicate. First understand and then by heart the definition. So in your head first, if you're clear about what is inherent risk, what is control risk, what is detection risk, then studying the bookish definitions is not going to be difficult. But for that, we need to simplify it as much as possible and understand what it is. So the next type of risk is the control risk. What is the control risk? Control risk is, there is a risk into the business, there is a risk into the company, but the controls in the company are not able to identify that risk. The controls in the company are not able to catch that risk. That is control risk. So there are so many risks in the business, and you have various controls that you have kept in the company to catch those risks, but maybe your controls are not strong enough that they can catch this risk. So this is control risk. There is a risk of material misstatement, but your controls cannot detect the risk, your controls cannot catch the risk. So there is a risk of material misstatement due to inadequate internal controls within the business. The auditor will make a judgment as to the suitability and strength of the internal controls, but your controls are not able to detect that risk. The controls are not able to catch that risk. What does that mean? In the company, you have various controls that are installed. For example, in one of the offices that I visited, in order to access the lift also, you need to have your company's card. Without that card, the lift door is not opening. Okay, so you need to have that card. You just tap that card there, the lift door opens, and then whatever floor you want, you cannot click any other button there. Whatever your card holds. So if you're going to go on the 5th floor, you can only click the button 5. That is the control that they have in their building, so that everybody's privacy is maintained, because every floor is having a different brand ka office. So to avoid all of that, they have that card system. Now this is a control which is there by the company. Now whether this control is working effectively or not, that needs to be checked. If the control is not working, if any card works, even if I put the debit card like this and if it is working, that means the control is not proper. So the control will not be able to catch that risk, or the control will not be able to detect that risk. So that is the problem. That is control risk. That means your controls are not in place, your controls are not working. It's there for namesake, but when you swipe any card, it allows you in. So that is control risk. And what is detection risk then? There is a risk in the company, but the auditor's procedures are not able to detect that risk. The auditors are not able to catch that risk. That is detection risk. So there is a risk that the work carried out by the auditor does not uncover a material misstatement that exists. So there is a risk into the company, and the auditor wants to catch the risk, but the procedures that are conducted by the auditor are not proper, or maybe they are not up to the mark and they cannot catch the risk. Auditor is trying his best, but the procedures he has adopted and the ideologies and the things that he has made is not able to catch the risk. That is detection risk. You are not able to detect the risk. This is the component of audit risk where the auditor has a degree of control over, because if risk is too high to be tolerated, the auditor can carry out more work to reduce this aspect of audit risk and therefore audit risk as a whole. And this depends. If the company is very risky, the auditor will need to conduct more procedures. If the audit risk is less procedures. But the procedures are not up to the mark. They are not able to detect the misstatement. They are not able to detect the risk. So this is the problem with detection risk. They are not able to detect it. This is a problem with detection risk. Okay. So 3 types of risk we studied: inherent risk, control risk, and detection risk. Okay. Inherent risk is what? That risk is there into the business. You do anything. I gave you 2 examples. One was sugarcane industry and one was the fashion industry. You cannot change anything about inherent things. Inherently my hair are black. I cannot do anything about it. I can color it from the outer surface, but the new hair that is going to grow is going to be black only because it's inherently black. So you cannot really do a lot of things about inherent risk. Before entering that business only, you're aware that in this business this is the 2% inherent loss that is happening. With that, you enter into the business. Like when you're entering into a sugarcane business, you know that this business is inherently like that. It starts losing its sweetness and all of that. If you're thinking of entering into fashion and retail, you know that this is a fast moving industry. You cannot be relaxed. You need to keep up with the trends. You need to keep a watch it. Okay, this movie is coming, I need to bring this clothes. After the movie is gone, okay, next this is coming, I need to come up with this. Okay, next this is coming, I need to come up with this. So these are the fast moving trends that you need to follow. And if you're not up to the mark, then your business is not going to work, because people also like shopping at areas where you get the latest fashion, right? And then the control risk, there is a risk in the business, but your controls are not able to identify that risk. And then the detection risk, there is risk in the business, but the procedures applied by the auditor are not able to detect that risk. Okay. With this, we will take a break of 5 minutes. Okay. Okay, let's resume. So the three types of risks are already known to us: the inherent risk, the control risk, and the detection risk. Now every risk in detail. Okay, what is an inherent risk? Inherent risk can arise due to the nature of the industry, entity, or the nature of balance itself. So it's there in the industry, it's there in the entity, it's there in the nature. Some people are by nature, they have, like I told you, inherent diabetic or whatever. Same. For example, inventory is inherently risky if it quickly becomes obsolete. What is obsolete? Out of fashion, as it may not be valued appropriately at the lower of cost or NRV as required by IS2 inventories. Now, inventories is something which is regulated by the standard IS2 inventories, and according to that standard, inventory should be valued at the lower of cost or net realizable value. If I have a fashion industry, I'm operating in the fashion industry, I have a store wherein I have a lot of clothes and all of that. I buy clothes, I have to value it at the lower of cost or NRV. NRV is the realizable value that I will get after I sell that material. So if I'm buying something recent, for example, I told you an example of the Barbie movie that came. So if I'm buying a lot of pink stuff, the lower of cost and net realizable value for me, for this point for the inventory, is going to be cost, because my realizable value is going to be more than the cost of that product. That is how I'll make a profit in the business. But after 2 years, if items of those inventory have still remained in the godown, they are not sold, they have become obsolete, nobody wants to buy pink items anymore because the fad is over. Now there's an audit risk that it is still at cost. Today, the net realizable value after 2 years of that product is going to be less than cost because nobody wants to buy it. So then I have to revalue it and put it at the lower of cost and NRV, and this time the lower is the NRV. So that is inherent risk, that my inventory is not valued appropriately. Because when I purchased the item, the lower of cost and NRV was my cost. But after 2 years, when the item became obsolete, now nobody wants to buy it, the lower of the two is going to be NRV. Because nobody wants to buy it, the realizable value becomes less. So that is my lower of cost and NRV. Okay. So that is according to IS2. The next is control risk. Okay. Control risk is the risk that a misstatement that could occur, and that could be material, which is not prevented or detected or corrected on a timely basis by the entity's controls. As I told you, there's a misstatement that is there, that is also material, but it cannot be prevented, detected, or corrected by the entity's controls on a timely basis. It is not, the controls are not able to catch it, the controls are not able to correct it. So that is the control risk that we are facing. The client should have controls in place such as authorization, segregation of duties, reconciliations, physical controls, etc., to prevent and detect misstatements occurring when transactions are initiated, processed, or recorded. So when you have authorizations given to certain people, when you have segregation of duties, so that every person is responsible for that own category, so he can specialize in that category. Now when you have a big organization, if you have one person who is responsible for everything, then it's a problem, because he will concentrate on the production, or he will concentrate on the packaging, or he will concentrate on the sales, or he will concentrate on stocking. It's a mess. But when you have segregation of duties, every person knows that what task is assigned to him. If I am assigned the sales, I will try my best to make the sales maximum. If I am assigned for the production, I will try to make my products in as much as less cost as possible at the most economic rate with the utmost quality. So that is segregation of duties. And when you have segregation of duties, you can specialize in the segregation aspect that is given to you. So if production is given to me, I can specialize on that. If sales is given to me, I can specialize on that. Then reconciliations, physical controls, etc., to prevent and detect misstatement occurring when transactions are initiated, processed, and recorded. If effective controls are in place, the control system will either prevent the misstatement from occurring or will detect misstatement that have occurred, and the client can take action to correct them. If your controls are in place, if your controls are proper, the control system will either prevent the misstatement, because before the misstatement happening, the controls are able to prevent them, or it will detect the misstatement which has already occurred and give you an indication that you have to correct them. Like the misstatement has already occurred and you have to correct them, or it will prevent it in the first place. So this is the what you can say, advantage of having a good internal control in place. The controls will prevent it and also detect it if the misstatements have already occurred. So this is the, the essence of having a good control system within the company. If controls are not effective, control risk will increase and there will be greater risk of misstatement occurring in the financial statement. So as a company, if your controls are not strong, if they are not proper, if they are not up to date, control risk is going to increase and there will be a greater risk of misstatement occurring in the financial statements. So that is why you need to have good controls in place if you want to prevent the misstatement, and if not prevent, after the misstatement has happened, if you want the misstatement to be detected. So that is the essence of having a good control in place that is going to prevent, detect and correct the misstatements occurring, and that is going to help your organization grow better. And the last one we have is detection risk. As I told you, detection risk is the procedures which are performed by the auditor are not able to detect a misstatement. So again, there is a misstatement which is there into the business. It is there very much into the business, but the procedures that are performed by the auditor to catch these misstatements are not appropriate enough. They are not able to catch this risk. That is known as detection risk. So detection risk is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists and that could be material. Misstatement that could be material are not detected by the procedures. Maybe the auditor is too new into the industry, so he exactly doesn't know what procedures need to be adopted, or maybe the auditor doesn't have that much judgment on the matter that is going on, or maybe the auditor is too naive to understand what needs to be done. So that can be the case. So he has a lot of procedures in his mind, but those procedures are not matching with the situation that he is in. He might have a lot of ideas. Whenever there's a new joinee into the company, ideas might be many, but what will work in the company and what will not, that will be understood once he applies their ideas. There's always a trial and error phase also. So here the auditor might have a lot of procedures, but the procedures are not able to detect the mistake. So that is the detection risk. Now detection risk is further classified into two categories. One is the sampling risk and one is the non-sampling risk. So what is a sampling risk and what is a non-sampling risk? Detection risk is further divided into two categories: sampling risk and non-sampling risk. What is sampling? Arises from the possibility that the auditor's conclusion based on a sample might be different from the conclusion that could have been reached if the entire population were tested. For example, I will give you. When the auditor goes into the company to audit the company, it is practically impossible for the auditor to check everything in detail, because first of all, the company that is there is very big. Operations are spread across various branches. There are a lot of transactions. It is practically impossible for the auditor to check each and every transaction in detail. But the auditor needs to give his report to the shareholders that everything in the company is going well. How will the auditor do it? The auditor has no other option but to conduct sampling. Sampling means what? Selecting samples, picking up samples. Now methods of sampling are also there, but that's a different thing. There are various methods by which you can generate the sample. But what the auditor will do? The auditor will do sampling, because it's practically impossible. If the auditor sits and checks every transaction in detail, The audit will complete after 2 or 3 years depending on the size of the organization. And if the organization is a very big organization, we don't know how long it will take. But the audit needs to be completed in a stipulated time. So for that, the best thing that the auditor can do is conduct sampling. So auditor will enter into the company, and looking at the size of the company, the auditor will resort to sampling. Now what samples need to be selected and what not is purely a judgment of the auditor. For example, if I am a teacher in school, okay, and I am a disciplined teacher, and in my school it's not allowed for girls to paint their nails. So if I want to check if the girls are painting the nails or not, I will randomly select 5 girls every Monday and I'll check their nails. And I'll check if they're not painting their nails. So that is my way of, because if I check everybody's nails, there's going to be so much time pass that is going to happen in the school. So every week I will randomly select 5 girls from each class. That is sampling. And based on this sample, I'll give my conclusion. That okay, students of 8th grade are not coloring their nails, students of 10th grade are not listening and coloring their nails, and etc. So my conclusion will be dependent on the sample. Now what is sampling risk? Sampling risk means the conclusion that I have derived from the sample is different from the conclusion I would have derived if I had checked the entire population. That is a sampling risk. Means my sample was not a proper representative of my population. Maybe I selected the wrong sample. That is why I have a sampling risk. Means the conclusion that I derived from checking a sample is different if I would have checked the entire class. So my sampling was wrong. My sample was not a representative of the population. For example, maybe from the 8th grade, I chose a group of girls who are very simple and are very India shell and all of that. But the actual girls, the other girls, were the ones who were coloring their nails. So my sample selection was wrong. So that is sampling risk. I repeat, what is sampling risk? The conclusion that is reached from checking a sample is different from the conclusion that would have been reached if the entire population was tested. That is a sampling risk. That means my sample was not a representative of population. So that is sampling risk. Then what is non-sampling risk? Non-sampling risk means there is a risk because of a sample due to any other reason. The auditor did not sufficiently investigate a significant balance. The procedures used may have been inappropriate or misinterpreted. That means there is a problem for any other reason than sampling. Sampling risk is purely because my sample was not a representative of the population and I couldn't select a proper sample. That is why the conclusion was different had I tested the entire population. But here in non-sampling risk, the conclusion is different from some other reason. Maybe the procedures that were applied by the auditor were not up to the mark, or the entire system by which the audit was conducted was not proper, or excuse me, for any other reason for that matter. So non-sampling risk is a risk for some other reason which is not sampling. So detection risk again divided into 2 branches: sampling risk and non-sampling risk. Okay. A very important line: professional skepticism. What is professional skepticism? I told you, when you're entering into a company and when you have a client which is your new audit client, you don't know much about the client because it is the first time that you're going to audit that particular client. So in that situation, what will you do? Because you don't know about the procedures that will be conducted, you don't know about the ideologies of the client, you don't know anything about the client. It's the first time that you are ever going to enter and you're going to audit the client. In this situation, what will you do? What will be your response to such a client who's a new client you don't know anything about? How will you combat that client? You will exercise professional skepticism. That means an attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatement due to fraud or error, and a critical assessment of audit evidence. When you enter into the client's premises, you know that this is a new client for me. I know nothing about the client. So you include an attitude that will come with questioning mind. Ask a lot of questions. Why this? Why not that? Why do you do this? In your organization, how is sales recorded? How is purchases recorded? How do you conduct procedures? Questioning mind. Why questioning mind? Not to irritate other person, but to find out about the company, because you don't know the company. You don't know about how the operations. Every company is different. If you have switched jobs, you might have known the atmosphere in every company is different. The way of working in every company is different. So if you as an auditor need to be on the same page as the company, you need to know about the procedures of the company. You need to you need to learn about the company. For that, you need to have an attitude that includes a questioning mind. Ask questions about the company. Being alert to conditions which may indicate possible misstatements due to fraud or error. Give me 1 minute, I'll just have water. Yeah. So you need to have and you need to ask a lot of questions about the company, because that will give you an idea about how the company operates and of the various things in the company. And then being alert to conditions which may indicate possible misstatement due to fraud or error, and a critical assessment of the audit evidence. Since you know that it is a new company you have no idea about, you need to be extra cautious to all the conditions that you might feel that because of these conditions there might be a fraud. There's a possibility of fraud because of these conditions and all of that. So basically you need to be very alert when it's a new client, because you don't know what is happening there in the company. And when the auditor is associated with the company, your name is associated with that company. So if there's something wrong that is going on in the company, ultimately your name also is going to be affected, because you are the auditor, so your name is going to be spoiled. Because of that, you need to have professional skepticism for first time clients, because you need to kind of learn about that company, if the operations in the company are good enough or whatever, because your name is going to be associated and you don't want your name to be spoiled. Because if you want to make a name into the market as an auditor, as an independent auditor, first impression is the last impression. So you do not want to be associated with a company itself which is like not up to the mark. Okay, so for that you need to have this professional skepticism. For that you need to have this attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatements due to fraud and error. But how to apply this professional skepticism? We know that there is a professional skepticism that we need to apply. We know that we need to be alert to the conditions. We know that we need to be alert to the conditions which may indicate possible misstatements due to frauds and errors. But how will you apply this professional skepticism? So that is a thing that you need to understand. What is professional skepticism? A questioning mind, being alert to conditions which may indicate possible misstatements due to fraud and error. But how will you apply that? Audit evidence that contradicts with other audit evidence. As an auditor, when you go into the company, if you're thinking about purchases, you will get various audit evidence, but you will get various other audit evidence also that are going to be contradicting with this audit evidence. It means that one person is saying one thing and the other person is not agreeing with that, he's saying the other thing. So either person A is lying or person B is lying, and this is a new client for you. So what you will do? You will use your professional skepticism. You will question both to find out the truth, because audit evidence is contradicting with other audit evidence. So one person is saying that we are getting raw materials from Kerala, other person is saying we are getting it from Jaipur. Whom to trust? How come both are saying different things? So that is audit evidence contradicting with other audit evidence, and for this you need to apply professional skepticism. Then start asking questions to them. Be alert to the possible misstatements due to fraud and error. Be alert, have a questioning mind, and all of that. Information that brings into question the reliability of documents and responses to enquiries to be used as audit evidence. That means if person A is saying that we are getting raw materials from Kerala, you ask him to prove that how you're getting the raw materials from Kerala. How is it possible? If one person is getting raw materials, he says that he's getting raw materials from Jaipur, he needs to prove how he's getting it from Jaipur and things like that. So you need to back your items with the reliability of it. Conditions that may indicate possible fraud, circumstances that suggest the need for audit procedures in addition to those required by IICs. That means for every evidence that you're obtaining, you need to back that evidence. That okay, this is happening because of this. For every evidence that is happening, you need to back that evidence. Okay, remember that. So that is how you will apply professional skepticism in a company. Guys, excuse me for my throat, it's a little bad today. So okay, so that is how you're going to apply the professional skepticism. Then there's so much fuss about materiality in general in audit. What is materiality and what is material, what is not material, how will you decide it, etc. What is materiality? When can I say that a particular item is material to me? Misstatements including omissions are considered to be material if they individually or in aggregate could responsibly be expected to influence the economic decision of users taken on the basis of the financial statements. So, misstatements including omissions are considered to be material if they can affect your decision whether to invest in the company or not. For example, I go to invest in company A and the company A has omitted something. I come to know about it later. Is it going to affect my decision to invest in the company? Like after I came to know about what they had omitted, about what category it was, whatever, is it going to affect my decision to invest in the company? Am I going to say that, oh, if I knew it before, I would never invest in that company? That means it was material for me. And if I say that, okay, it's not a very big deal, even if I had known about it before, still I'd invest in the company. That means it was not material for me. It didn't matter for me, right? If 500 rupees fall down from my purse, if it was really material to me, I'd react. If 10 rupees fall, if it's not material, it's okay. It might be somewhere like that. So if it is going to affect your decision to invest in the company or no, that means if it was material for you, that is why it has affected you. And if it is not affecting you, that means it's not material. It was something which is normal, so it's not material. That is the meaning of materiality, and you need to know the definition of materiality. Misstatements including omissions are considered to be material if they individually or in aggregate could responsibly be expected to influence the economic decisions of the users taken on the basis of financial statements. Now, materiality is explained in detail further. The materiality levels, materiality considerations, and performance materiality. So there's one more topic of performance materiality. Now I would like to tell you one thing, that is materiality only about size? Like, is it only about the 500 rupees and the 10 rupees? Is it only about size, that okay, 500 is a big number, it's big money, you can buy a lot of things, so it is material. 10 rupees is not material because it's minor, doesn't matter. Materiality is not just about size, materiality is also about nature. Sometimes it's not about where the 10 rupees in your wallet is missing, it's about who must have taken it, the nature of the transaction. Has it gone by robbery, or has it, that needs to be found out. Sometimes it's not about size, it's not about the 500, the 1000, the 2000 or the 10 rupees, but sometimes it's about the nature of the transaction. Why has the 10 rupees gone missing? What is the reason for that? That is important. So materiality is not just about size, it's about nature also, about the nature of the transaction. Okay, so materiality by size is this. What can be material by size is 0.5 to 1% of your turnover. So if your turnover is 1 lakh rupees, 500 to 1000 and above is material for you. Okay, so 0.5 to 1% of turnover, that is 500 to 1000 and more, is going to be material for you. Similarly, 0.5 to 1% of gross profit is going to be material for you. 1 to 2% of your company's total assets is material for you. 2 to 5% of your company's net assets is material for you. 5% of profit before tax is material for you. 5 to 10% of profit after tax is material for you. This is materiality by size, and it depends from organization to organization. Now you're seeing how it depends from organization to organization, because if your turnover is 1 lakh, your materiality for turnover is going to be 500 to 1000. Similarly, if your turnover is 10 lakh, then your materiality is going to be 5000 to 10,000. That becomes your 0.5 to 1%. So it changes from the size of organization to organization. And since it changes from the size of organization to organization, it is known as materiality by size. Okay, so 0.5%, 0.5 to 1% of turnover is different for company A, who's making a turnover of 1 lakh. It is different for company B, who's making a turnover of, say, 10 lakh. So that is materiality by size. Quantity, that is the magnitude, but there's also quality that is involved, that is materiality by nature. So if 10 rupees from my wallet go missing, I'm not concerned about the amount of that, whether it is 10 rupees, whether it is 10,000 rupees. I'm concerned about where is the money going, who has removed it from there. That is the nature of the transaction. So I'm more interested in knowing about the nature of the transaction than the actual size of materiality. So materiality can be important by size. It can also be important by nature. Next we have is the performance materiality. Now we have studied the topic of materiality. We know what materiality is. What is performance materiality? Materiality is, for example, 0.5 to 1% of turnover. If my turnover is 1 lakh rupees, my materiality according to 0.5% becomes 500 rupees. So less than 500 is not material for me, okay? And my organization is making a turnover of 1 lakh. So 300 is not material for me, 200 is not material for me, 100 is not material for me, 400 is not material for me, 450 is also not material for me. Anything over and above 500 is material for me. But consequently, if I'm having misstatements of 200, 300, 400, 450, when I aggregate them together, they become material. Because 200 plus 300 plus 400 plus 450 plus 100 plus 50 together becomes more than 500. That is performance materiality. It is a level below materiality, and when you aggregate all of this, it becomes material. So that is my performance materiality. So what is performance materiality? Amounts set by the auditor at less than the materiality for financial statements as a whole. It is an amount set less than the amount that is there in materiality. For in materiality, if it is 0.5 to 1%, it is less than that. So anything less than 500 for our company with a turnover of 1 lakh, wherein 0.5% is 500. So say 100, 200, 300, all the aggregated together becomes ultimately material. So amount set by the auditor at less than the materiality for financial statements as a whole to reduce to an appropriately low level the probability the aggregate of uncorrected or undetected misstatements exceeds materiality. Now these were aggregate of undetected and uncorrected misstatements like 100, 200, 300, 400 up to 450. But when you see it individually, it is not material. That okay, 500 is material for you, but less than 500 okay, 100, 200 not material. But at the end of the year, when you aggregate all of these non-material things, it somewhere becomes material for you. If you add up 100, 200, 300, 400, 450, again 50, this, that, together, it is material for you. So that is performance materiality. This is lower than the normal materiality. The idea is that this will try to prevent all those small undetected errors which do not aggregate to become material. So individually they are not material, but when you aggregate them, they definitely are material. So that is performance materiality. Again, performance materiality explained in more detail. Performance materiality is the amount set by the auditor at less than materiality for the financial statements as a whole to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceed materiality for the financial statements as a whole. As informed to you, it is a level that is below materiality, so that all the undetected and uncorrected errors that go like you ignore, when you aggregate them together, they become material. The auditor sets performance materiality at a value lower than overall materiality. So if your overall materiality is 500 rupees, performance materiality is at a level below that, and uses this lower threshold when designing and performing audit procedures. This reduces the risk that the auditor will fail to identify misstatements that are material when added together. So when you add this individual 100, 200, 300 rupees together, it becomes material for you. So that is performance materiality. Before we begin with the risk assessment procedures, we will take a small break of 10 minutes. Okay. Okay. So, risk assessment procedures. The next topic that we have is risk assessment procedures. The auditor should perform the following risk assessment procedures, that is, inquiries with the management of appropriate individuals within the internal audit function if there is one, and others with relevant information within the client entity, example about external and internal changes the company has experienced. So, what are the risk assessment procedures that the auditor will conduct when he goes into the company to audit the company? So, the auditor has entered into the company. He's an independent party. Okay, so he's an independent person who will go into the company on behalf of the shareholders to find out about the company. So, what are the procedures that he will conduct? See, he will not go without any guidelines. He will not directly go into the company and just start over with anything or anywhere. He will go into the company with a certain set mindset that, okay, I want to inquire about this, I want to find out about this, because obviously he has to get a report for the shareholders, because he's appointed by the shareholders to go into the company and find out about the company on behalf of the shareholders. So he will do inquiries of the management. He will find out details from the management, like how they are doing business, where the funds are invested, how they are invested, what they are doing, etc. Of appropriate individuals within the internal audit function if there is one. So if there's an internal audit function, he will find out details about all of that, and others with relevant information within the client entity about external and internal changes the company has experienced recently or maybe in the past, about the various analytical procedures that the company undertakes, observations, example of control procedures. He can observe certain things if the controls in the company are working, like I gave you an example of the lift. So he can observe if you can enter the lift only by swiping an appropriate card, or is it possible by swiping any other card. This will be known not by asking somebody but by pure observation. Then next he can do is inspection. He can himself inspect a certain things, like, okay, I want to inspect the key strategic documents and procedural manuals, or I will find out myself. So if the company is claiming to be at the top, or if the company is claiming to be one of the best, I will not just listen to what the company is saying, but I will inspect it myself and find out. I will go into the market, I will conduct a survey and find out if whatever the company is saying is actually true or not. So that is my way of inspecting things. Okay, so that will be a part of my risk assessment procedures. Then again, about materiality, I'm saying if my turnover is 2 lakh, then what is material for me? Is 10,000 material for me? So I will take 2 lakh on my calci and I will do 0.5%. So anything above 1,000 is material for me. So 10,000 is definitely material for me, but all these things are not material, because my materiality level is 0.5 to 1%, which is more than 1,000 of 2 lakh. But individually 200 is not material, individually 300 is not material, individually 500 is not material, individually 600 is not material. But if I add up all 200 plus 300 plus 500 plus 600, they become 1,600, which is more than 1,000, which is my materiality level. So all these aggregated together become my performance materiality. Okay. Next in audit risk is something known as analytical procedures. So I have analytical procedures. Evaluations of financial information through analysis of plausible relationships among both financial and non-financial data, and investigation of identified fluctuations, inconsistent relationships, or amounts that differ from expected values by significant amount. So analytical procedures is analyzing relationships between data for any fluctuations. Like last year I made a profit of 10,000, this year I'm making a profit of only 8,000. Why is there a fluctuation? Find out. Last time I made a profit of 10,000, this time I'm making 20%. Why so much fluctuation? Find out. That find out is the analytical procedures. Analyzing relationships between information for any changes in the information. So that is analytical procedures. So evaluations of financial information through analysis of plausible relationship among both financial and non-financial data. Now, what are the analytical procedures that the auditor needs to follow? Okay, analytical procedures that the auditor needs to follow. help identify inconsistencies, unusual transactions or events, and amounts, ratios, and trends that might have audit implications. So, any inconsistencies, like every year, if you're consistently going a step ahead in profit, like every year, this year 10,000, next year 12, 14, 16, every year you're going, but suddenly there's an inconsistency. Maybe you fall suddenly, or maybe you rise very suddenly. So, what is the reason of that inconsistency? You will find out. So, that find out is your analytical procedures. Any unusual transactions or events that are happening suddenly into the business, suddenly something new is coming up into the business, or suddenly something new is happening, about any amounts, ratios, sudden trends also. Maybe you have a trend of going upward, but suddenly there's a problem. So then there's a problem in the trend that might have audit implications. Help identify risk of material misstatement due to fraud. If there's any material misstatement due to fraud, as I told you at the start of the lecture, fraud is intentional, error is unintentional. So any risk of material misstatement due to fraud can be a problem. Identify and assess aspects of the entity of which the auditor was unaware. Maybe a certain aspect of the company, or maybe a certain category of the company, the auditor was unaware about, completely unaware about. So it will help to identify and assess the aspects of the entity of which the auditor was unaware about. Comparable information for prior periods. If you want to check the trends, if you want to see the trends, you need to have comparable prior period information. With that, you can see the trends, and then you can analyze if something is going wrong. So with the trends, by studying the trends, you will able to analyze that, okay, this is going wrong, I'm not going with the trend, or something unusual is happening in the company. How will you understand? Suddenly, if this year's data, if I see, suddenly I can check if something unusual is happening? No, I will have to check the trends, I will have to check the forecast, I will have to check the prior period information, and comparing only will give me an idea if something wrong is happening with the trend. So comparing with the prior year, or comparing with the similar company in the similar industry, or comparing it with competitors will give me an idea of if something wrong is happening. Anticipated results of the entity, such as budgets or forecast, or expectations of the auditor, such as estimation of depreciation, will give me again an idea of if something I'm doing out of the box or something is going wrong into the company. Because when I anticipate results of the entity, when I look at the budgets, when I look at the forecast, explanations of the auditor, estimation of depreciation, all that will give me an idea if something else is going wrong. Similar industry information, such as a comparison of the entity's ratios of sales to accounts receivable with industry averages, or with other entities of comparable size in the same industry. As I told you, how will I know if something unusual is happening or if something different is happening? Is by comparison. Comparison with what? With the prior years. If prior data is not available, what if you're a first time in that company? What if you're a new company? Obviously, there might be a situation somewhere wherein you're new. You don't have prior period information to compare. Then what will you compare yourself with? You will compare yourself with similar companies in the industry. You will compare yourself with similar similar competitors in the industry, so that you will understand where you stand. For example, if I'm entering into a market as a shoe manufacturer, I will compare myself with similar shoe manufacturers who are new, not very hi-fi branded also, depending on what category I'm entering. If I'm entering into that hi-fi market, I'll compare myself with that hi-fi competitors. If I'm a normal producer of footwear for college students, wherein you can change the styles regularly with less money, I will compare with them. So then similar industry information, comparable, is all that is required, and those are the analytical procedures that the auditor needs to follow in general. Okay, so I want you to go through and read through this. I will quickly look at if there are any comments. I'll just quickly check. Okay. there are any messages so far. Then about the ratios. Now ratios is a very important topic in audit and assurance, and in any subject that you study in ACCA there are ratios. Okay, so what are the different type of ratios that you will come across in AA? Profitability ratios, finding your profit. First one is the gross margin ratio, gross profit margin ratio, and the ratio is gross profit upon sales revenue into 100. That will give you an idea of your gross profit to your sales. How much profit you're making in response to your sales is your gross profit ratio. So for example, if your gross profit margin is 20%, that means on your sales you're making a profit of 20%. So which is more the profit, better it is. Then the operating profit ratio. Operating profit margin will give you an idea of your operating profit to the sales revenue. So how much profit you're removing in your operations in relation to your sales revenue by 100. Then next will be your efficiency ratio. How efficient are you in the business? Receivables collection period, receivables upon revenue into 365. What is receivable collection period? It gives you an idea of how quickly you're collecting your receivables. If 3 people have to pay back me my money. My collection period will give me an idea of what is a cycle of my receivables. How quickly am I receiving my receivables? Am I receiving it in 50 days? Am I receiving it in 40 days? The lesser it is, the better. Lesser it is, from my perspective, is better that I'm getting my money back. My cycle is quick. That is receivables collection period. Now, when I compare the receivable collection period of this year with the prior year, it kind of gives me an idea that, okay, from the previous year, if my collection period has gone down, that means my receivables have become more efficient. I'm getting back the money quicker. Payables payment period is how quickly I'm making the payments to my creditors. The more the period is, the better it is for me, because I have the benefit of time value of money. So every time I will think from the company's point of view only. So payables, the late it is, it's better, but it should not be very late, because if it is very late, that means you're facing some serious cash flow issues. That means you cannot make payment, and that is going to degrade your name. So if the payment that is offered to you by creditors is 60 days, you make sure you use the entire 60 days. Don't make payment before that. You make sure that you use the entire time value of money that is available. Okay, so what is the payables payment period? Payables divided by purchases into 365. So that is the payable payment period, and make sure that you don't go overboard the time that is allotted to you. So if the time that is allotted to you is 30 days, don't go beyond that, because then beyond that, if you go and every time if you make it later, the creditor will next time not give you proper payment period. Inventory holding period, for how long the inventory remains in your godown. 30 days, 40 days. The lesser it is, the better it is. The lesser it is, that means your inventory gets sold off that faster. If there are more inventory days, that means the inventory is taking time to kind of go from your godown. That means you have a lot of obsolete, you have a lot of old inventory into the godown. Okay, so that is inventory holding period. The faster it is, the better it is. Inventory divided by cost of sales into 365. So the faster it is, the better it is. Asset turnover, how quickly your asset is turned over into revenue, how quickly you're selling your assets. Revenue divided by total sales. These are some of the key ratios that will help you if you want to invest in the company or not. Looking at the company, looking at the inventory turnover, you will understand that, okay, your inventory is getting sold off quicker, or your inventory is getting sold off. So that will that will kind of give you an idea. Then we have liquidity ratios. What are the liquidity ratios? How quickly you can convert your things into liquid cash. Current assets upon current liabilities. What is the ratio of your assets to liabilities? Your assets should be more than your liabilities. If your liabilities are more, that means you're a loss-making company. So your assets should always be more than your liabilities. In your real life also, the assets that you own should be more than what your liabilities are. Then you have the quick ratio, which is like a little brother of the current ratio. So what is the quick ratio? Current assets minus inventory divided by current liabilities. So this is your quick ratio, which removes the inventory in general. So these are the liquidity ratios. Then the investor ratios. For the investors, gearing ratios. Gearing means finding out how risky a company can be. There are different categories of investors. All the investors are not same. If you ask me, I'm a medium category investor. Medium as in medium risk. Some investors are risky investors. They like more risk, more return. They are willing to take that risk. So if they are investing in a very risky company, either they are getting a very large return or they are getting nothing at all. That is a risky investor. Medium is medium risk, medium return. Low is low risk, low return. You might be an investor wherein you want a very low risk. Your returns are low is okay, but your risk should be low. So different categories of investors. Now there are so many companies that are available into the market. You should select a company based on your risk-taking ability. Now my risk-taking ability is medium, for example. So I will invest in a company which is going to give me medium risk, medium return. So that is my gearing. So that will come to know. How will I come to know? By looking at the investor ratios. So the gearing is borrowing upon share capital plus reserves. That will give me an idea of how risky my company is. And depending on that, I can select a company which suits my category. So my category is medium risk, medium return. So I will go ahead with the company I will go ahead with a project that will give me medium risk, medium return. Then return on capital employed, ROCE, how much capital I am getting in return of how much return I am getting in comparison with the capital that I have applied. So if the capital that I have put into the business is 1 lakh, on that 1 lakh how much return I am earning. So it is return upon capital employed. So that's it with the key ratios. We have profitability, efficiency, liquidity and investor gearing ratios. Okay, so now we studied about the various audit risks that we have: inherent risk, control risk, detection risk. Then we studied about the 2 types of detection risk, that is the sampling risk, the non-sampling risk. We studied about the different materialities, performance materiality, then materiality by size. It's not about materiality by size, but you also have to look at materiality by nature and all of that. So that's it about audit risk that I had to tell you today. From tomorrow, we are going to start solving the sums on audit risk. So from the exam style questions, so these were the questions that appeared in the exam in the past. So we're going to take the questions, we're going to identify the audit risk, and we are going to give our response as to how we can improvise on this risk. I hope this session was useful to all of you. Thank you so much for attending this session, and see you guys tomorrow.